We have a situation where we can fill up our ships and there's containers left over. And what the reaction to that is, okay, every ship that we can bring back, let's bring it back. And very quickly, that's what brings an end to kind of higher freight rates.
The rates now are at the lowest level since the end of December 2023. Would you bet against another major incident happening in the next 18 months? Because I certainly wouldn't. Will freight rates drop to pre-Red Sea crisis levels on the Transpac? Welcome to The Freight Debate, the ultimate destination for supply chain professionals, logistics leaders, and anyone who's ever wondered what really keeps the world moving. I'm Phil Hennessy from Xeneta, and joining me for The Freight Debate again is our senior shipping analyst, Emily Stausbøll. Hello, Emily.
Hi, Phil.
Groundhog Day again, another tariff story yesterday. So for information, it's now the 12th of August, the day after the announcement from the US and China that the lower tariffs will continue for another 90 days. Every freight debate, we promise we won't talk about tariffs, but what can you do? So any thoughts on that, Emily, before we get on to the main event for this freight debate, tariffs wise?
I think Groundhog Day is a good way to put it. I think probably if we had been betting on it, that's our bet would have been another extension into the next 3 months. We'll see if come that day we're closer to an ending or it just keeps dragging on. Clearly some respite from those importing from China, maybe a little bit of a boost in demand as people see this next window as an opportunity. But I doubt it's what's needed to kind of turn around the falling spot rates. It's not what carriers should be expecting to turn around their fortunes.
Well, that is a wonderful segue into the main topic of conversation for today. So this week's freight debate is asking the question, will freight rates drop to pre-Red Sea crisis levels? And for the purposes of this, we're looking at the Far East to US West Coast spot rates, but we'll also touch on long-term rates as well. And if you're listening or watching this, you can actually read a really in-depth blog authored by Emily on this very topic, which kind of forms the background to this edition of the Freight Debate, and that's now published on the Xeneta website. So if you're interested in this, I'd really recommend you visit the website and take a look at that blog post by Emily, because it's really in-depth and incredibly valuable and interesting. Right, Emily. When we spoke about this, you didn't want to pin your colours to the mast, did you?
Yeah, I think we were a little bit further away from where we are today, if we think 2 weeks back when we first had this discussion. But I'll let you ask your question.
I want a straight yes or no, and then we'll go into the reasons why, but why can wait. Are we going to see spot rates drop to pre-Red Sea crisis levels from Far East to the US West Coast?
What's the time frame? Sometime this year? Yes.
Sometime this year?
Yes.
Great. Right, got it on record.
Easy.
There's Emily's prediction. And the point
and then we'll record a version of this where I say no, and we can just put up whichever one fits.
Yeah, but the point is that we can have fun with this, can't we? Because as you are, you're going to inflate your ego here, but you are, incredibly knowledgeable about this. But it kind of doesn't matter how knowledgeable you are, does it? Because as we'll discuss about this in more depth in this episode of the Freight Debate, there's so many factors that are going to influence this that clearly are outside my control and your control and anyone else who's listening or watching this podcast control. So you can say yes or you can say no, but actually we need to look at the factors that can determine that, don't we really?
Yeah, absolutely. And I think carriers have a big hand to play here, and we obviously don't know what they're thinking. One of them, let alone all of them, and that has a big influence on what we're gonna see going forward. Whether they can kind of manage this capacity enough to keep rates maybe above those pre-Red Sea levels. I mean, I don't know. For context, today we're just a couple of dollars above 2,000 USD per FEU, Far East to US West Coast. We were under that. We were closer to 1,800. Phil, correct me if I'm misremembering. So there's still $200 there. That's still 10% if we compare it. So there's still a way to go, especially when you consider that the declines have been slowing since kind of the past few weeks. But there is a possibility we get back down there.
Yes, that's true. But people might be wondering why we raised this question now. And the reason that we do raise this question now, and it's in the blog, and hopefully we can put the image on the screen if people are watching this episode of the Freight Debate, is that the rates now are at the lowest level since the end of December 2023. And for reference, the Red Sea crisis escalation was kind of, we can say like, it was like the 14th or 15th of December, wasn't it, 2023? So for the purposes of this, we'll call pre-Red Sea the 1st of December 2023. So yes, you're right. Rates are kind of still, whatever it was, $200, did you say, above that pre-Red Sea crisis level. But when we think in July last year, when rates reached the post-Red Sea crisis peak, it was above $8,000 per FEU. Then, it's put it this way, it's much closer to pre-Red Sea than it is to the peak, the post-Red Sea peak.
Absolutely. Clearly, and I think those year-on-year comparisons are now showing these huge declines, and that's why we're kind of moving on, because yes, there have been big declines, but rates are still sort of higher than they would maybe otherwise be. And I know we're talking about kind of pre-Red Sea, but if you take that a step back and say, okay, pre-pandemic, if you think about kind of, we're on this $2,000-ish point, 2017 to 2020, and I could be mean and ask you to take a guess, Phil, but I think I won't do that. I wasn't working at Netta then. I thought you'd say that. But in that period, so in about 1,200 days of those 3 and a bit years, you only had 200 days where we were above 2,000. 2,000 was a high point in that case. And since then, since that, 1st of June 2020, we've been above 2,000 80% of the time. And that's a huge shift as well. So it's both comparing kind of to pre-Red Sea, but we're also going back and looking at those pre-pandemic comparisons of kind of some returning to what we would have considered normal pre-pandemic. Whether or not that's then what sticks around is a different question. But we're around that benchmark where we're getting back to where we were pre-pandemic.
Yeah. That's interesting. And I mean, it's interesting for me and you. I suppose if you're a shipper listening to this, it's more than interesting. It's there's a major financial kind of consideration here, because we talk about rates plummeting, don't we? Kind of this year in the tariffs, but they're still above what they were pre-Red Sea. That Red Sea effect is still there. But anyway, more of that a little later, because to understand why rates are dropping, shall we just give a very brief understanding of why they peaked in the first place? Is usually a good place to start, isn't it? Because we say they peaked because of the Red Sea, but that's not really kind of, it's not to the levels of analysis that we're used to from Emily.
Well, and that's kind of, there's been 2 peaks in the past 2 years. There's the peak last July, which was driven by the Red Sea, and then there's been the peak this year, which was driven by tariffs instead. So it's also just, splitting those 2 things out. And we never fell back to lower levels after that initial Red Sea jump, but then we were pushed even higher up, sort of early summer months when we got the tariff announcements. Yeah,
but it's worth highlighting you mentioned carriers and the role that they have to play as to whether rates do actually go down to the pre-Red Sea crisis levels. So let's think about why the role that carriers had to play when the rates increased. And again, we're talking about, for the purposes of this, Far East to US West Coast trade. Now, in the immediate kind of first half of 2024, obviously that trade isn't impacted by the diversions in the Red Sea and going around the Cape of Good Hope and those longer sailing distances. But carriers moved capacity off that US West Coast Trans-Pacific trade onto the trades that were operationally impacted by the Red Sea conflict. And the stats actually is March 2024 offered capacity on this trade fell to the lowest level since July 2023. And that then coincided with shippers rushing all the cargo because of the Red Sea disruption and volatility, because they wanted to protect the supply chain. So it was that kind of perfect storm, wasn't it, of lower capacity and front-loaded of imports, and then we saw that peak, and that's why we got that huge peak.
That front-loading was also driven by these labour threats of strikes on the East Coast and the Gulf Coast back then, that was also pushing people to move earlier than they might otherwise have done.
So when we think about the influence that carriers have on this story, the peak, the post-Red Sea crisis peak, was reached in early July 2024, and that coincided with the all-time record capacity being offered on this trade by carriers, which happened in the a 4-week rolling average in 8th of July. So, the same time. That's not a coincidence, is it? And it just demonstrates the importance of capacity and demand on this trade, that actually rates went so high, but capacity reached a point where actually they started to soften again.
Yeah, and it's what we see time again, that carriers are almost ruining it for themselves, because they will see a trade where rates are increasing and they'll think, I want in on that, but they're not the only ones to have that thought, and suddenly you have all this extra capacity coming in, and that's what leads rates to start falling again. And it's something we see repeated in this year as well.
Yeah, carriers have FOMO, don't they? That's what it is.
And I think we say that on this specific trade with this specific rate, but to a certain extent you can say also when you talk about contracting for new ships, as soon as they start making money, they order new ships. And some will say it's fleet renewal, and that's fair enough in many cases, but there is also fleet growth. And when you're already looking into a picture of capacity, just because you're earning a bit more money now doesn't mean that the best idea for your long-term profits is to order more ships, which will only arrive 2 years from now when we might be in a completely different situation. So that was just sort of higher up, but let's get back to...
Yeah, there's a whole other episode there on MSC, I suppose, isn't there? So 2025, fast forward. So we talked about why rates peaked in 2024, 2025. Again, we'll flash up a chart on the screen if you're watching this episode of the Freight Debate, because you can see the relationship between capacity and freight rates on this trade. We saw a decline in demand, dramatic decline after Liberation Day in April, which saw freight rates kind of, soften even more.
They didn't after Liberation Day.
That's true.
And it, I think we made the comparison before to the pandemic, that actually then with this huge collapse in demand out of China, carriers removed enough capacity not to send rates up, but to keep rates flat despite this huge drop in demand. So at the moment we're talking about kind of peaks, but there is also an element in them. They were managed to avoid rates really collapsing when demand was doing so for that half a month, 2 weeks.
Right. Yeah. Okay. So they managed capacity in the immediate aftermath of Liberation Day, which meant there was lower capacity on this trade. And again, look at the chart if you're watching this. Capacity really, really dipped down, didn't it, in May? But then that coincided with the lowering of the tariffs, and capacity had been managed, inverted commas, lowered. And then there was that kind of that short-lived cargo rush. And again, on the chart, you can see that massive spike in freight rates at the start of June, isn't it? 1st of June, we saw up 75% between 31st of May and June the 1st. But again, if we now look at capacity on this trade, it's now at the highest level since the peak in 2024. So they've overshot again, haven't they? Because rates now are plummeting back down towards pre-Red Sea crisis levels.
Yeah, and I think we were probably amongst those, I'll maybe not speak for you, but I think we agreed that we expected the kind of cargo rush out of China to have a longer lasting upwards effect on rates. They would stay higher for longer. And that didn't happen. And partly that's with the capacity that came in. I think there's also probably overshot how much demand there was to be moved. But there's also a time lag here that actually for the first maybe a week or two after the Chinese tariffs were paused, carriers were looking at a situation where they couldn't just suddenly find all these ships and put them into China and they were ready to go. These ships had to come back from somewhere because a lot of them were sent out on other trades back in May. And that means there was probably a period where they were thinking, actually, here we have very, very tight demand here. We have a situation where we can fill up our ships and there's containers left over. And what the reaction to that is, okay, every ship that we can bring back, let's bring it back. But by the time they all get back, you're already starting to see the top of that demand. And very quickly, that's what brings an end to kind of higher freight rates. And because they overshot so far, really, that freight rates fell quite fast.
Yeah. Okay. So that being said, that's why we come to the conclusion. I say we, it's you. You're the analyst. You said at the start of the
Don't put it all on me.
Oh, I can do because I'm the host and you're the expert.
You want headlines as well. You'll always push me further.
I do want headlines. That's why I pushed you at the start of the episode. So then, I mean, on a more serious note, that's why we say, yes, there's a very good chance that freight rates are going to go down to pre-Red Sea crisis levels because there is the capacity, there is the demand, and linking it in with the latest tariff announcement yesterday of extending by the lower tariffs between US and China by another 90 days doesn't really change the situation. I don't think we're going to see a cargo rush like we saw the first time they extended the 90-day window. So that means they're going to keep falling. But carriers, and this is why it's maybe more advisable to sit on the fence with these things. Carriers aren't just going to say, okay, we'll let rates drop down to pre-Red Sea crisis levels because they face potentially loss-making positions, don't they? Or certainly dramatically less profitable positions, despite what some leaders of big shipping companies said this week. Much less profitable positions than they were.
And carriers are looking at a situation where rates, I mean, they have already removed capacity on the Trans-Pacific trades, also into the East Coast. But there are still rates on other trades that are profitable. You look at the European trades, they're down slightly, but they are comparatively at a higher level than into the US. So at the moment, there's still other attractive trades for them to move that tonnage to, which I think speaks to the fact that they will remove more of that tonnage, and that's why we're seeing kind of the considerable slowing of the decline on spot rates into the US. That kind of holds for the shorter term when we still have higher demand. We still have some peak season volumes into the US, also into Europe, keeping demand up a little bit. But I think if you look into kind of later this year, from late September onwards, it becomes different because if what we're seeing is right, there's less of those other trades left. At a certain point, we have enough ships in the fleet to deal with that demand. And then suddenly you're no longer saying, I'm going to move this ship from this trade where rates are falling to this trade where I can make more money. You're looking across the board at trades with lower rates. And then you're thinking, okay, is this finally what it means that I need to now not charter these extra ships, or I send some of these really old ships that should have been demolished 3 years ago, I finally send them away. That is not a thing that happens overnight. It takes a long time, but a little bit further down the road, we could be well looking into that situation.
Yeah, and this is a problem that's facing all carriers, isn't it? They're all facing this, and there's going to be a reaction from them all. And maybe at the end of the year, I don't know, maybe you start to see a little bit of a pickup in demand again, which could maybe put a little tighten capacity a little bit, but it's not a great.
I think the end of the year is unlikely in terms of the sort of seasonality of demand. Then you start looking up forward towards Chinese New Year and the imports ahead of that. But I think we've had this early peak season. The kind of the good stuff this year has sort of passed. Maybe we've got another 3 or 4 weeks of it before we really start to see that demand falling, both because of front loading into the US coming to an end, but also because actually peak season volumes have been moved ahead in other places. So there's. Yeah, I don't think there's much good news on the demand front if you compare what we've had in the first 6 months of this year to what we're expecting in the second half.
Yeah, just to give an idea of the problem facing carriers of managing capacity. Again, we'll put this chart on the screen, and it's in the blog as well if you're listening to this and want to see it. From an index baseline of 100 in 2019, the global shipping fleet size now stands at 145 points. But in the same time period, global container shipping demand has increased from a baseline of 100 points to just 113 points. So fleet growth is outpacing demand growth.
Yeah, 45% demand growth versus 13%. Yeah, or the other way, 45% fleet growth, 13% demand growth. That is a huge gap between the two. And of course we've still, and this is demand measured in number of containers moved. So there is still a factor of actually we're still diverting around the Red Sea. That means TEU mild demand is much higher. So those demand numbers are not really reflecting how much work there is for container ships to do. But even so, you're looking at maybe 20-25% demand growth rather than the 13. And that is maybe also, I don't know, people who follow the industry closely will have seen Maersk being a little bit more optimistic about the second half of the year than maybe Phil and I are every day. But there is also some element of that is still keeping kind of work for container ships up. When that goes, you have another big problem. But I think what's clear when you're looking into even those diversions, which have a huge impact on the fleet, is not enough to save the back half of this year for carriers.
No, I mean, who am I to say, to disagree with Maersk, but I think their glass is certainly half full, isn't it, for the rest of the year when we're looking at demand, I would say. But anyway, we'll see, won't we?
We will see.
So that's where we are, really, isn't it? Yes, it's certainly from a spot rate point of view. Yes, I think we can say likely, possible. Edging towards likely that it hits pre-Red Sea crisis levels, which will be good news for any shippers that are listening to this episode of the Freight Debate. As we said, not so much for the carriers.
You don't have to chuckle evilly while you say that, but
I'm totally neutral. And Zanetta, and just to say as well, do you know what? It's actually a good point that we should make here, isn't it? Zanetta are totally neutral, and the whole premise of our service is that the rates are kind of crowdsourced and it's neutral. And as much as we chuckle, we are neutral in our analysis. So that's spot rates, long-term rates, which will also be extremely important for shippers hurtling towards the end of 2025 and into 2026. Peter Sand, our chief analyst, thinks long-term rates are going to drop below Red Sea crisis levels. Are you going to disagree with the chief analyst of Zanetta?
Never. But I think there's some context there that long-term rates, yes, they rose in the Red Sea and they rose in 2024, but they never rose as high. We never got anywhere near what we got on the spot market. So there's much less of a difference. And that's also the case. We've seen much less movement in long-term rates this year. And it's not because they haven't followed the spot market down. It's more because they never followed the spot market up, because we were seeing this as I think we were seeing this as more temporary push to spot rates than it turned out to be. But that same pressure wasn't there. So there it's looking more likely, and not because of the huge downward pressure at the moment, but because we never rose to the same heights. And I think shippers will want that. Shippers are looking at a price for importing goods, including tariff, that's much, much higher than it was last year. And they're going to look at however they can reduce those costs. And one of the levers to pull there is the long-term rates they're signing, and really getting down kind of to the cheapest rate they want to, and they think that they can afford to get away with.
Yeah, I've got a question on that actually in terms of negotiating tactics, but just picking up the fact that you mentioned there that actually they're still being hit by these tariffs, aren't they? So the cost of actually importing the goods is much higher, and if we think about the kind of orders of magnitude, any savings in freight rates is going to be swallowed up pretty quickly, isn't it, by the tariffs? But also, lower demand is just not good, is it? Lower demand, we use the word demand, but really it's trade, isn't it? It's buying, and there's just less stuff being moved, and therefore less stuff that businesses are buying and selling, and that's just not good for anyone, really, is it? So yes, we can talk about, isn't it good for shippers that rates are decreasing, but we're looking at a tiny piece of the puzzle here, aren't we? There's a much bigger picture that is a lot less attractive for a shipper.
A lot more bleak.
Yeah, a lot more bleak. Yeah.
Yeah, and I think we haven't seen the full extent of the impact of tariffs on US demand in particular. A lot of those costs, either because of front loading that you've managed to avoid the tariffs, or at the moment companies are kind of taking that and not passing it on. At some stage that changes, and that then should really hurt the kind of retail data and what consumers are buying, and therefore so how much needs to be imported. And I think we're yet to see anywhere near the the scale of which we'll see it, because of these two things that are kind of isolated the US consumer at the moment. But it's clear demand is a reflection. Demand in container shipping is a brilliant reflection of the global economy and trade and healthy economies, and this is not painting the best picture.
It really is, and that's why we get so many inquiries from kind of the largest media outlets in the world, because it is such a good bellwether for what's happening, is it? It's stuff being moved around the world. I saw a stat once. I think it's like 97% of goods are moved by ocean container, as in consumer goods are moved by ocean container. It's absolutely crazy. So it is an amazing bellwether for what's actually going on.
I think it's 90% of global trade is moved by sea. I think that's what you're after.
Is that what it was?
I think
Thank you for the correction. That's
the rule of thumb, I think I've heard many times.
I've only slandered global trade. They can't sue. It's an entity that can't sue me.
But I think maybe before we move on from the discussion on long-term rates, is just we're making this comparison to pre-Red Sea, and that is interesting in more ways. But what we were saying back there at the end of 2023 was this was a market moving in shippers' favour. There was overcapacity. The years of the pandemic have been rough, but we should be getting back to kind of normal, i.e. pre-pandemic dynamics in 2024. And that's where you as a shipper start saying, okay, I want at the lowest rate, I want to go for this, I want to go back to... And then everything changed. So again, just because we're back to pre-Red Sea or even getting close to pre-pandemic levels, I think there's a fair discussion in, are we actually going to get back to that? Because pre-Red Sea in a way was, okay, we're trending back to pre-pandemic. Is that a long-term sort of return that we can count on? Or are we going to continue to see the volatility in both directions that we have over the past 2 years? Do you believe we go back to 2018, 2019? And I think the industry has come too far from that level. The rates have been so much higher, and there's been so much more volatility that I really struggle to see us going back to, rates of around $1,800 plus minus maybe 500 in the space of 3 years. That was what we saw. And I think everybody has come too far from that to then go back to it. Yeah, and
the one way to look at it is, if you do chase that bottom dollar in your next contracts and you do chase, south of pre-Red Sea crisis levels, what you're doing really is you're betting against another black swan event. You're betting against another major geopolitical disruption or war or environmental climate related incident like drought in Panama, whatever it is. Given the world that we live in now, in terms of geopolitics or climate or just crazy stuff that seems to be happening in the world, would you bet against another major incident happening in the next 18 months? Because I certainly wouldn't, no way.
I would not put all my eggs in one basket. And of course, this is every shipper has to make this decision for them. For some, they are so big that actually they've managed to kind of be okay through the past 5 years because they've known the carriers need their volumes. For others, it doesn't make sense to ship at a higher cost because their margins are so thin. So there is never one answer for everybody, but it's definitely not us talking about a return to pre-Red Sea is not us saying all's well, let's go back to chasing the bottom dollar. That I think we need to stay far away from that. And then hopefully we can be surprised positively, but I wouldn't bet on it.
Yeah. Well, now Emily Stausbøll, senior shipping analyst at Zanetto, has said rates will definitely drop down to Red Sea crisis levels. Let's think
on this trade. This year.
On this trade.
We've got other trades to keep following that are further off, and maybe we can get back to those some other time. Yeah.
But just in terms of what a shipper can do, because we've just talked about the dangers of chasing that bottom dollar, but I'll counter that, which I think when we hear from Zanetto customers, there's that frustration, isn't there? That when there's a major black swan event, whether it's the Red Sea or whether it's the kind of uplift, the spike in demand following the tariffs, whatever it is, carriers immediately knock on the door and say surcharge, and they'll call it peak sea surcharge or whatever surcharge they want to put on it. But I think a shipper would say, yeah, that I kind of get that because it's maybe reasonable considering the circumstances. But when the market drops, then the carrier doesn't go knocking on the door again and say, oh, excuse me, Mr. Shipper, the market's dropped, so we'll knock some money off the price of you shipping your goods. Doesn't happen, does it? So a shipper now locking into a new long-term contract could be at a disadvantage if the market drops. But index-linked contracts is something that's kind of growing in popularity as well, doesn't it? That tracks the market up or down. But shippers, they should be thinking about this, shouldn't they? In the new long-term contract, whether it's an index link, whether it's linking it to an index, or whether it's just having a mechanism in there where they can knock on the carrier's door and say, listen, rates have dropped, sharpen your pencil type of thing.
Yeah. Or we've returned to the Red Sea, I don't want to pay a Red Sea surcharge anymore. There's many ways to do it. And that, those kind of things we mentioned, that's something you have to kind of agree on beforehand. But then there are other ways, once it's happened, you can play a little bit with your MQCs, you can look to the spot market a little bit more. But I think we've come back to this dynamic at the moment that on the Far East US West Coast, spot rates are basically in line with the long-term rates now since they've fallen so much. But it's always faster to go up than it is officially to go down. That's then when we start seeing, and we talked about this a while ago with these promo rates, where carriers are suddenly starting off, especially with smaller freight forwarders, and saying, I know this is the rate we've agreed, and this is the rate you get, but for a certain percentage of your volumes, I'm willing to give you this much, much lower rate because I need to fill up my ship. That will come. It just takes a while to kind of go through the smaller freight forward, bigger, and then onto some shippers. But shippers should be very aware of what they're signing up to and aware of the risk that comes with it and how you can kind of avoid that.
Yeah, and a shameless plug for Xeneta, and I make no apologies for it. If you are going into those negotiations with carriers and you are a shipper or freight forwarders, whoever, then the capacity data that we've discussed in this blog, and there's kind of that relationship between rates and that relationship between the long and the short term contracted rates, and that information, the information that you dig out about capacity, supply, outpacing demand, all that kind of stuff. If you walk into that room, if they do it in the room, you log into that Zoom meeting with that data up your sleeve, you're going to be in a far better position to justifiably say to that carrier, I'll this is the rate I'll agree to, but actually I want this index link mechanism added to it, or I want this mechanism where we can revisit if it falls by a certain threshold. Having that data is going to be key, is it not?
Key when you're negotiating, and then also 6 months down the road when things have collapsed or things have changed, and you say, actually, I can see the market has moved. I can even see that you, carrier A, your average rate is down, so I want to follow that down. So both when you go into negotiating, but then also the rest of the year when things change, you want to be sure that you know what's changing. If rates are falling, to then go and say, look, we need to look at this. Or if rates are increasing and thinking, okay, how do I then protect myself against this potential increase and all the risks that involves?
Yeah, wonderful. Okay, brilliant. Thank you, Emily. Well, I think we've answered the question. Will freight rates drop to pre-Red Sea crisis levels on the Transpac? Yes, but with an asterisk at the end of it, with a whole list of supplementary notes to consider. Now, amazing, thank you. And as I said at the start, we go into much more detail in Emily's blog on the website. So please visit the Xeneta website. It's in the resources section of our website, and you can have a look at the charts and all of the extra analysis that Emily's put into that. But until the next freight debate, thank you, Emily, for pinning your colours to the mast with this one. It's been really interesting, and we'll keep a track of freight rates. When it gets to the end of 2025, we can hand out awards for good predictions. Or not.
Or just slowly disappear.
Brilliant. Okay, wonderful. Thank you, Emily. Thank you for everyone who is listening or has watched this episode of The Freight Debate. If you've enjoyed it, and I hope you did, then please hit subscribe. We've got plenty more episodes with Emily coming up, and we've also got some guests from people across the industry as well lined up, which should be really interesting to hear diverse range of views on the topics that we discuss here. But more of that to come. Until then, thank you very much, and we'll see you on the next episode of The Freight Debate.